Welcome to Factful Finance, where we turn financial complexity into clarity. Ever wondered why most financial experts recommend index funds to beginners? Let's break it down so you can start investing with confidence. Did you know that over 80% of actively managed mutual funds fail to beat the market over the long term? In fact, many investors, especially beginners, face the dilemma of where to put their money. Index funds might just be the answer. Before diving in, a quick note. This content is for educational purposes only. Please consult a financial professional for advice tailored to your personal situation. Index funds are a type of passive investment that track the performance of a specific market index, like the S&P 500. This means when you invest in an index fund, you're buying a small piece of each company within that index, spreading your investment across hundreds or even thousands of stocks. Let's look at why that's so valuable. First, let's talk about simplicity. Beginners often feel overwhelmed by the complexity of the stock market, and rightfully so. Index funds eliminate that confusion by offering a straightforward set-it-and-forget-it investment strategy. Instead of trying to pick individual stocks, which can be time-consuming and risky, you're essentially betting on the broader market. And since the market tends to grow over time, index funds give you exposure to that growth without the need to micromanage. Now, consider risk. One of the biggest mistakes a beginner can make is putting all their eggs in one basket. With individual stocks, you could end up holding a losing investment in a single company. But index funds help spread that risk across many different companies. This is called diversification, and it's key to managing risk in your portfolio. Think of it like not putting all your money into one restaurant. If one fails, the others can help balance things out. Next up, cost. Actively managed funds usually charge higher fees because they involve managers making decisions about what stocks to buy and sell. In contrast, index funds have very low fees because they simply track an index. Over time, those savings add up. For example, if you invest $10,000, a 1% fee could cost you $100 per year. It doesn't sound like much, but over decades, that fee can really eat into your returns. Index funds are also great for long-term growth. The stock market has historically returned about 7% per year on average after inflation. While this is not a guarantee, it's a solid track record. By investing in an index fund, you're able to take advantage of this long-term growth without the stress of short-term volatility. Let's talk numbers. Let's say Sarah, a 25-year-old beginner, invests $5,000 in an index fund that tracks the S&P 500 with an average annual return of 7%. By the time she reaches 65, assuming she adds no additional contributions, her initial investment could grow to around $38,000. That's the power of compound interest, and it shows how starting early with simple, low-cost investments can make a big difference. But what about tax benefits? When you invest in index funds, you're often taxed less than with other investments, since the fund doesn't frequently buy and sell stocks. This means fewer taxable events, and in turn, a more tax-efficient investment strategy. So to recap, here's why index funds are highly recommended for beginners. 1. Simplicity. No need to pick individual stocks, just invest in the overall market. 2. Diversification. Spread risk across many different companies to protect your portfolio. 3. Low costs, low management fees that add up over time. 4. Long-term growth, benefit from the historical growth of the stock market. 5. Tax efficiency, fewer taxable events make them a more tax-friendly option. If you're just starting out on your investment journey, index funds provide an easy, low-cost way to get your foot in the door. You don't have to be a financial expert to begin building your wealth. What's the first step you'll take toward your financial future? Share it with us in the comments below. Thank you for tuning in to Factful Finance. If you found this video helpful, be sure to like, subscribe, and click the bell to get notified when we post more insights to help you make smarter financial decisions. Until next time, keep investing wisely.